Hi, my name is Neve Topping and this is the Do More of Your Money podcast. I'm joined today with Luke Johnson-Bolton, who's the head of the High Net Worth Advice team, and Craig Almond, who is the head of the Technical Planning team. So today's podcast is on the topic of why affordability in retirement matters, and today we're just looking at kind of insights into what income you may need for retirement and how that matters essentially. So what we're kind of starting with is how to know how much money to need in retirement. So I'll pass that on to you, Craig, to start off with.
Yeah, I think that's a kind of really funny question that we often have with clients. We sit down and say, what do you spend now? And I think most clients probably aren't conscious. They don't actually have a clue about what the outgoings are. So we have to break it down normally and understand types of expenditure, what's frequent, what's maybe ad hoc, but really what's essential to your living, what's discretionary kind of expenditure, then what's the luxury stuff which sits above that. And that's how we kind of start the financial plan from there. So essential expenditure is, things you need to live. So it could be, council tax, TV licence, which everyone has to pay or not, bills, food, water, so on and so forth. Your discretionary spending is kind of the additional things which, for some people they have to go on holiday every year. That is a discretionary element of spending. They might want to go out and socialise and leisure spending. For some people that is just everyday spending, which we class as discretionary. Then the additional layer of that is luxury. Some clients may not go on holiday, and actually going on holiday might be a big luxury to them. We can identify and really make it specific to that client what luxury expenditure looks like. Once we have that kind of framework mapped out, we can very quickly identify their expenses and then proceed to developing a kind of robust financial plan from there.
Perfect. So yeah, there's a number of options in how you take that income as well in retirement, and there'll always be different stages where you come to take different parts of income at different stages of retirement. What would you say were the main options really, Luke, with coming to take that income?
Yeah, of course. So for our clients, they may have a few ways to meet their needs. The first point is to look at what they're going to spend. If identified that maybe they're at retirement, they might have a pension, an ISA, maybe some shares or a general investment account. We need to look at how those are all taxed compared to what the client needs to get the most efficient way in which we can take that income. So you could use a mix of all the assets. You could use flexi access drawdown within a pension where you could take maybe some taxable income and tax-free cash. You could mix it up with an ISA, which is tax-free income, and a general account to maybe make use of a capital gains tax allowance each year. So there really is many different ways a client can meet their needs depending on how much they spend and what assets they have. We need to look at that. We need to look at potential for growth rates, but also tax is a big one in there that we need to look at, because obviously those products are all taxed very differently.
Absolutely. And how would you say, Craig, when you're looking at retirement planning, how you take into account things like inflation?
Yeah, so we generally cash flow. So cash flow is a main tool which myself and the advice team use in head office to really map out clients' assets and are they going to be sufficient enough to last their retirement. I think a stat from the National Office of Statistics was 1 in 3 people born today will last to age 100. So for most clients from age 60, let's say, it's a 40-year term. Your pension's going to have to last you, and over that 40 years, you're going to have ups and downs in the markets. You're going to have changes to interest rates. You're going to have, ad hoc things which spring up in your own personal life, which require attention and indeed funds. So we really have to kind of stress test clients' assets to identify and ensure that there is sufficient funds in place to give you a long and fruitful retirement. So that's kind of the main tool that we use. I don't know if Luke has any more on the cash flow side.
I think that's a really interesting way to do it, Craig. I think inflation is really important. Although we have a national inflation rate, everybody's personal inflation is different because you'll spend your money differently to me. That's why it's really important to look at what clients spend their money on. If they spend a lot of money on things like petrol, that's going to be subject very heavily to inflation, maybe more than other things. So it's really important to look at that, look at clients' individual circumstances, identify exactly what they need for income and lump sums.
Yeah, absolutely. And what would you say would be your scenario really when you spoke to a client and they say, look, I've got multiple pensions, multiple sources of income. How would you recommend I take that, or what would be the best way to start with that?
Yeah, it's a really good question. Craig's mentioned the cash flows, which is going to show different stages maybe of retirement or income and expenditure. We're going to look at things like maybe state pensions, annuities, fixed levels of income that could come in at different times. So we're going to identify the shortfalls that they're going to have, the tax they're going to pay, and really the most efficient way to establish what they need for themselves, but also to help build legacy, look at other goals for the clients to make sure that obviously minimise tax for themselves, but also maximise the amount that can go to family or whoever they want to leave their assets to as well. it's all about building that roadmap into retirement planning, where we can see very clearly this might be your first shortfall, your second shortfall, third shortfall, etc. And how do we meet that in an efficient way?
I think as well to that, as Luke said, that's very much creating an initial plan. I think what's important is you go through the life cycle of retirement to have regular reviews with your advisor, because naturally things will change. There'll be unforeseen expenditure which crops up, which will potentially devalue your assets. So having regular reviews with those advisors and updating that plan at each step through retirement on an annual basis, or maybe even more frequently for some clients, will really be advantageous again to allowing you to enjoy your retirement to its fullest.
Probably one of the biggest changes that we will have, obviously when we have budgets, tax changes, etc. We know that, the most recent budget and the changes to pensions and inheritance tax, this can change. So we can set a roadmap out, the income tax levels may change, the capital gains tax may change as it has done in the recent budget. And likewise, the way pensions are treated or other assets may change, as we know pensions are due to come into estate from 2027. So it's really important to work with an advisor who can keep an eye on what the government are doing, what the changes that they are making, because what's right this tax year might not be right for future tax years when there are any changes there.
Yeah, that's a good point from both of you. Retirement is hopefully a long thing, and things change every year, so it's always good to review that annually. Just in terms of withdrawal rates, we have a defined contribution pension that we offer. What would you say kind of about withdrawal rates and trying to make that pension last as long as possible, Craig?
Yeah, I think historically there's been a safe withdrawal rate that everyone has in mind, and that's kind of the target which they aim towards. It's kind of changed over time. It was 5%, 4.5%, 4%. It kind of differs who you speak to, but really what we're trying to demonstrate for most clients, if you're withdrawing a reasonable amount relative to your pot under review from an advisor, you should be all right for retirement. And there's going to be scenarios and potential occasions where actually you need more than 4%. Let's say you're 64, you've got 3 years till state pension age. You might have a £12,500 amount of income that you need to take on top of what you were planning to take anyways. That could be 6, 7%, 8%. Over a long term, that potentially isn't sustainable. But because it's planned for only 3 years, and we can demonstrate another guaranteed income source coming into play, that's perfectly fine. We can have a discussion. We can kind of build it into our plan again, and develop that robustness and flexibility to meet the needs of the client.
Craig, you did a really good point mentioning there how you work out the client's current expenditure. How would you say would be a good way to plan for their future expenditure? When you speak to clients, sometimes they say, I'm not sure, or I don't know what my retirement may look like. What would you say is a good method for them to use there, or good things for them to think about?
Yeah, I think identifying your current expenditure is obviously the starting point. From there, you can work away. So what's maybe not going to be around in retirement, it might be school fees for kids if they're at private education. It could be mortgage payments, which will cease when you're retired. You can eradicate and eliminate them from the client's current expenditure to give you a better gauge or guide of what their retirement spend's going to look like. In addition to that, they may be, I'm retired, I'm 60, I might have 10 years where I might go and enjoy myself, go on holiday, go travelling, do things that maybe I'm not being able to do whilst I've been working, and you can price and build it into their expenditure plan. So, as I mentioned there, for 10 years, they might want an extra £15,000 to go and see the world. Completely fine. We can price that in, we can build it into their expenditure and extrapolate what that looks like over the long term to see if it's firstly affordable and whether they've got the affordability to do that, but actually just to show how their expenditure is going to change through the various cycles of retirement.
Brilliant. And speaking about changing expenditure as well as looking at a regular income covering expenditure, what about those one-off kind of capital lump sums clients may need, one-off expenditures? Luke, I'll pass that one over to you.
Yeah, not only that, that's really important to think about, especially in retirement. You might think, every few years you might buy a new car, new boiler, all these sort of things that you might cover from income at the minute. You might not have the option to finance those, and you won't have the income when you're retired. So it's really important to sit with your advisor at the outset and look at how much you need to spend on these things. What you can then do is link that to your assets. So we've mentioned things like ISAs or tax-free cash within the pension. We know that they're going to be tax-free, so potentially we have to earmark some of your investments that we know we might need for tax-free lump sums to avoid paying a lot of tax in the future. So it's really important to look at what you spent before, or if you've got any big plans for big holidays, etc. When you do retire, it's important to know those with your advisor and look at how you're going to meet that need.
It's probably like an additional layer. So we're talking about essential, discretionary and luxury. Ad hoc's probably the fourth one, which we maybe don't always discuss, but it's just as important because it's those unforeseen costs which can put pressure on your pension pot and ultimately lead you with having not enough money. So an important element of cash flow, but actually just analysis of expenditure.
So you mentioned ad hoc expenditure there, Craig. Would you be able to elaborate on that and when things like, we talk about boilers and things like that, when it might be other things that are ad hoc that you need?
Yeah, obviously they're the big ones and they're kind of obvious, like, your boiler's broken in your new car. But there's probably more incidental costs that you're not conscious of. So it could be, how many times have you been at Tesco or the middle aisle in Aldi and you're like, oh, I'll get that. You completely don't need it, but it's just ad hoc expenditure that you'll just spend. Very quickly, those things can, and I can testify to that personally. That's why my wife doesn't let us go shopping anymore. So them are just building as much flexibility and contingency into your financial plan. Gives you that kind of leeway to allow for those incidental costs that maybe aren't at the forefront of your mind when you are looking at what you're spending.
We mentioned cash flow modelling and how that helps in retirement. How would you say, Luke, that cash flow modelling helps you with your clients when you're sitting down and planning their retirement?
Yeah, that's a really good question, Eva. Cash flows are really important because it shows the clients where you are now, your assets and income. If you're not retired, it shows how those could hopefully grow before you do retire and enter decumulation stage. So it's going to show a projection forward of your assets and how those are subject to things like growth rates, but also how much you spend. You can build in different scenarios, such as the 2008 crash. You can build that in to show the impact that would have if something like that were to happen again. So it's really useful for clients. We can see where they are now. We can see potentially if there's anything else they need to add in there. You can use it to identify things like legacy planning, how much will be left to family, of course, after we make sure that they're looked after and their income needs are secured.
I think the main point of the cash flow for an advisor, it builds in reassurance of the plan. And that stress testing of variables gives the client hopefully more answers to questions like, what if this happens, what if X happens, what if I spend more? It really just kind of pulls the plan in many different ways to see how your assets would cope, and it is that reassurance and reinforcement of the plan which is important.
So we've touched briefly on the different types of incomes you can have in retirement. What would you say about that, really, Craig, in terms of when clients are thinking about what income's right for them and factoring in, like we say, incomes such as state pension or potential final salary pensions? Yeah,
I think there's kind of two types of pension. There's two types of income, really, guaranteed and non-guaranteed. Obviously, there's upsides, pros and cons for both. Let's say if you're purely guaranteed income, it's guaranteed, it's in your bank every month, you know what you're going to get. Downsides to that is, you potentially may get less interest rates. If you're buying an annuity, let's say, you're very much dependent on what they look like. If you need more income, you can't do that. You haven't got the flexibility then to go and top things up. On the flip side of that, you've got flexi access drawdown, which allows the client to just draw what they want when they want. Again, the benefit being you can do exactly that. The downside being, you're running longevity risk there. You've got the potential to run out of money. It's not going to be there every month. It's subject to market risk. X, Y, Z. So there is two very distinct types. For me, when I'm working with clients and looking through retirement plans, I like to see a mix of both. So really that essential spending as a minimum is covered pretty much by guaranteed sources, which means that no matter what happens, your standard of living at its core can be maintained from an essential expenditure point of view. Then in terms of the discretionary and luxury, there may be the more ad hoc sort of things. Then you can use your flexible income to top it up. The benefit of that being, it might be higher initially in retirement. Having that flexibility to take more initially, then taper off as you get older, is beneficial for that client. One, it means they can meet the needs, but actually it retains more of the pot for later in retirement for the potential beneficiaries. So having a blend of those two income types is really the way to go, in my opinion, when advising clients around retirement and their expenditure.
So we're talking about taking ad hoc lump sums and why it's good to keep tax-free funds in there for that. What could be the potential consequences if someone hasn't got those tax-free lump sums left and they need to take like a lump sum out of their taxable pension? Yeah,
Niamh, that's a good question. There's two consequences really. The first being that you're going to have to take a lot more from your pension to get the net amount that you need. A real life example, a client I had with a pension with no tax-free cash left that needed to buy a car for £50,000. But the amount they need to get that net amount, looking at their individual tax brackets, is going to be a lot more because they're going to pay higher rate tax on the lump sum. The second consequence is that potentially you're going to have to claim tax back. So if you take a taxable lump sum from your pension, depending on where you are within the tax year, HMRC may overtax you because they may think that actually you're going to get more income than what you are. So there's two consequences really, and that's why it's really important to try and set out the lump sums that you might need and make sure if you can, leave things like ISAs, cash and tax-free cash from pensions for those lump sums.
So just to summarise, managing finances, it doesn't have to be overwhelming. It's what your advisors are here for. What we would say is as well to, once you have a strategy for retirement planning, to review that regularly. There's going to be changes in government rules, there may be changes in your circumstances, and there may be changes to your assets and other investments. So it is best practice to review that at least every year with your advisor. What we would say is as well to think about inflation and market changes, and really factor that into your retirement planning as well, which is again why it's good to have a financial advisor on hand to speak to at least once a year, just to make sure your plans are up to date. And there's no one size fits all solution. It's important to emphasise that every situation is unique, so we would recommend getting a tailored advice recommendation from a financial advisor. Thank you for watching, and if you'd like to, please like and subscribe.